Welcome to another episode of the Vital Strategies Podcast. I'm your host, Patrick Lonergan, and today we have a truly insightful conversation with Pete Worrell. I have so much respect for Pete and how he conducts business. He is a powerhouse in the entrepreneur community and author of Enterprise Value. Pete is known for his unique approach to helping entrepreneurs increase their company's value through strategy, culture, and mindset, and then positioning the business for sale to capitalize on the hard work the entrepreneur has poured into the business. In this episode, Pete shares how entrepreneurs can fuel their mission by involving management teams in the company's future, the critical role of incentivizing employees, and the importance of developing relationships that can define who is and who isn't your buyer. We also discuss the one trait that separates great entrepreneurs from the rest. Be sure to listen all the way to the end, where Pete has an exclusive gift for our listeners that you won't want to miss. Let's get into it. Pete, welcome to the show. I am excited to have you today. On the show today, we've got Pete Worrell, Managing Director of Bigelow, also co-CEO. I'm excited to get into who Bigelow is and what you do there. But before that, I just want to acknowledge I've spent a very short amount of time with you, but in that short amount of time, I always feel like I come away better. You're just so willing to share insight, connections, resources. It's really something to aspire to. So I do appreciate that example you set for me, and I'll say the entrepreneur community. So welcome.
Thank you, Patrick. I mean, part of my approach, I think, is we live in this world of mass popular culture that most entrepreneur owner managers feel a stranger in. I mean, Dan Sullivan, our mutual friend, would say most entrepreneurs always feel like the dumb kid in the room, and couldn't understand why we didn't get the best grades, we couldn't focus the most, we didn't whatever. And so for me, my antidote to that has been go first, go positive.
Yeah.
So it's always like the hand outreached, bring value first, and see what happens. And I guess if you do that, sometimes you'll be disappointed because some people will try to take advantage or whatever. Mm-hmm. And I've just determined for me, only for me personally, I'm willing to endure that cost because the benefit of having people that you strike up relationships with that you realize, oh, they're one of us, that you throw your arms around them and you hold on to them as tight as you can because after all, there aren't that many people like that in this culture, right?
Yeah, no, that's fantastic. And it might be a great filter, right? Like it's not a lot of fun to get into business with people like that are just take. So if you test the waters a little bit with spending time with people and you're giving, and then you see they abuse that, it's like, okay, this is good. Maybe we don't want to take this relationship into something to a deeper level. So I love that. Thank you. So I also have to acknowledge a couple books that you've shared with me that have also been just really good. And I think this is going to fit into our conversation about enterprise value. You're an author as well for a book with the same title, Enterprise Value. And you're really good at helping entrepreneurs understand what drives that. But the books, they don't sound like enterprise value books, but they're around this topic of positive psychology. The first one was Flourish by Martin Seligman, and the second was Be Your Future Self Now by Ben Hardy. I don't know if you want to just take a minute and share a little bit about mindset and how important that is for the entrepreneur to really be able to grow and scale their organization.
Yeah, I mean, I think it goes back to our childhoods, Patrick. The big lie that we were told by everyone around us was work on your weaknesses. And that was something we needed to unlearn because obviously if we have weakness, we all have weaknesses and we work on them, we'll make them sort of mediocre, but we never really excel in them, right? So the fundamental precepts of positive psychology, of which Marty Seligman is the founder and the father of positive psychology in about the year 2000, is that instead of trying to fix weaknesses or fix what's wrong. Rather, you build on strengths. You try to define, again, what in coach you'd call unique ability, and then you build on that and build on that. And so, very much so, whether it's Flourish, a book that Marty wrote about flourishing and thriving and what it takes, which, by the way, are characteristics that are vastly different from just fixing a weakness, or whether it's the great book by Ben Hardy, Be Your Future Self Now, which really changes the mindset from the, again, going back to the clinical psychology mindset, which was, oh, you have issues that you're trying to become somebody new. We have to look at your past. Let's talk about your family of origin. It's all about the past, the past, the past.
Yeah.
Ben brilliantly turns that on his head and says, actually, what if we think about it as the future, this most compelling and colorful future, and how does that affect our present and our past? And I find that to be extremely compelling, and I find that to be something that other high performing entrepreneur owner managers really resonate with.
Yeah, absolutely. I love it. And I think a key thing that we see regularly, and I'm sure you do as well, it's like you can teach entrepreneurs all the tactics, right? But if they don't have the right mindset as to like wanting to grow and believing what's possible and have a vision for the future, uh, the tactics don't really matter. They're going to stay stuck in their current mode, and so I just I think there's a combination when somebody has the right mindset and the vision for where they want to go, like they will figure out the tactics to get there. But you can teach somebody all the tactics, and if they don't have the right mindset, they'll keep doing what they're doing. They're sort of limited by their mindset. So I think
Yeah,
those pieces.
I so agree with that. I think you're being really insightful, and you're also, I think, also just getting into a area that I would call strategy.
Mm-hmm.
Sometimes we ask our friends and our clients, "Do you have a strategy that's so
Yeah.
simple you can say it in one sentence?" And again, you've just pointed out, actually, that goes to mindset.
Mm-hmm.
And it's not about being in the weeds. It's not about tactics or execution. Just for the moment,
Yeah.
let's just go up to 40,000 feet and talk about strategy and culture and mindset. And you're right. That's exactly where we start as we start thinking about how do you build enterprise value.
Yeah, I love it. So, if it's okay, can you? I've sort of jumped right in. Can you give us an overview of Bigelow and what your organization does, and then we'll get into this concept of enterprise value. Can we start there?
Yes, sure. So Bigelow is most widely known for being the investment banker or the merger and acquisition advisor exclusively to large, high performing entrepreneurs. So we work with people who own and lead large enterprises who sometimes come to us, Patrick, with the question, how am I going to get this business to continue to succeed beyond
Yeah.
me? Or how am I going to continue to succeed beyond my personal ownership of it?
Yeah.
We're all terminal, right? So at some point, we all face these issues of what happens next. And so we specialize in dealing with entrepreneur owner managers. And we don't think it's ever too early to meet them because someday they're going to be thinking about building enterprise value, some of them for a capital gain someday. Our firm was founded in 1935. We're a very small, scrappy boutique firm located just north of Boston. Our clients are all over the country. We are very adamantly not segregated into industry specialties, and I can speak to that if you'd like.
Yeah.
And we spend all of our time with these entrepreneur owner managers. And just to be clear, we never represent public companies. We never represent a portfolio company of a private equity firm. We only represent people who have skin in the game, who have created large, successful, valuable businesses.
I love it. Thank you. And I think when I think about if I'm going to just define some of these things, and I'm going to talk top line because it's sort of an easy metric to look at. But are you maybe not top line? Let's talk about valuation. We're probably thinking of on the low end. $50 million valuation. You're probably doing a lot of transactions around 100 million and then some up in the $500 million range. Is that a fair assessment of Bigelow and the type of client you work with?
Yes, exactly. You put your finger on it. And I would say that, between us, we don't really talk about this vocabulary with our clients, but between us, we also would be only what you call sell side. So in other words, we only represent the entrepreneur in trying to find the best possible investor in the world
Mm-hmm.
who's going to be a great partner for them going forward. And so
Yeah.
all the time, we're working on the side of representing the entrepreneur seeking a new investor.
Yeah. Fantastic. And I'm looking forward to getting into that a little bit because I think there's some things there. But before we do that, can we start talking about enterprise value? Because I've been, we've had a few conversations and I've been thinking about this quite a bit. Just what really moves the value or moves the needle on enterprise value. And so, if we just start off and we think about the entrepreneur and where they begin, usually there's a problem in the marketplace and they go, hey, I can fix that problem. And so they show up and they're gritty and they've got this, hustle, innovative spirit, and they figure out how to grow. And it's very dependent on the owner to sort of make it happen. Um, but then eventually we need to move out of that mode, right? Like we need to start bringing some people in around us that will help us grow and thrive. And in your book, you talk about the four hats of the entrepreneur. You know, they've got one head, but they gotta play these different roles. Can you talk us through the four different hats that the entrepreneur wears?
Sure. So, what we say is for entrepreneurs, four hats, one head, big problem. So, entrepreneur owner managers, all of us, right, have a personal hat where we're looking for personal growth or we're trying to unlock personal potential. We have a family person's hat. We have a CEO hat, and we have an owner's hat. And I would say for owner managers, Patrick, my experience has been that we spend about 95% of our time as managers thinking about execution and the plan and how we're going to tactically advance the ball. And we only spend 5% of our time as thinking as owners. At Bigelow, we have that upside down. We spend 95% of our time thinking about how is this going as an owner? What are your goals? And what are your hopes and dreams as an owner that you're trying to get this to become? And are you actually advancing that? Because it's our view that you don't have to be interested in selling your business to want to increase or optimize enterprise value. In fact, to be dramatic, we say that from increased enterprise value, all good things come.
Mm-hmm.
If you want to have, a better success sharing plan with your employees, increase enterprise value. You want to be able to put on that extension to your new laboratory, increase enterprise value. And so we feel like these things that we do, these principles that we use to increase enterprise value are good for the really, really long term. And then going back to where you started, and then, oh, by the way, if you want to have a capital gain someday, you'll be prepared to do that because you've been optimizing your enterprise value.
Yeah. I love that. And I think there's, when we think about this, sometimes it's easy to get caught up in like, oh, we're going to, and I want to preface this as I'll resolve these issues I'm talking about here. I want to do the best thing for the employees. I want to do the best thing for the customer, the client. And at the end of the day, if we do the best thing for the organization, we're going to do the best thing for both the employees and the customers. And it's not like we have to do it in either or. And I think about this in a few capacities, like building a championship team. Like if we fill our team with A players that have high standards, that's really good for everybody involved. We coach them up to a good level or excellent level. And then the organization can then take care of the customer client at a fantastic level. But we also have to, remember all along the way, we've got to, like a business doesn't exist unless we're generating revenue. And so we got to generate revenue. We have to do it efficiently. The more money we can drive to the bottom line, the more we can grow and expand our mission. And I think most entrepreneurs have a purpose, right? Like they're excited about this vision for the future, and they want to make an impact more than just throw a few more dollars on the bottom line. And so I think that fits into sort of this personal and family piece of the hats that we're putting on. It's like, I'm doing all this to make a better life for the people that I care about. And over my shoulder, it says, make life great. And we look at that from a finance perspective with our client. It's not about adding another zero. It's like, how do we live a full life and generate as much wealth as possible, pay the least amount of tax possible? And so I'm curious how you see enterprise value sort of affecting all of these different hats and allowing somebody to go, yes, I have the freedom and flexibility to live well because of this business.
Right, and I think you have framed very beautifully, actually, a discomfort that many entrepreneurs feel, where they feel, in many cases, very mission-driven, and they care very deeply about the outcomes they have that for their customers or for their clients. And some of them get a little confused, feeling that if I'm mission-driven, then I don't really want to build my enterprise value because I must be building enterprise value with profit and wealth. And that goes against what my mission is. My mission is to serve these people. And it takes us sometime a while to help entrepreneur owner managers realize that actually, if you're really driven to accomplish your mission, you need positive cash flow to grow and to serve more people. And so if you can get your arms around that and realize that if you optimize your business model to have great cash flow, that will that will feed, that will be the fuel that your mission
Yeah.
needs. And so one of the things we look at, for example, on all of our businesses that we see with entrepreneurs is an example of how profitable is your profit.
Hmm.
What do I mean by that? Is just very simply, when we look at a business, like I was last week with a group and talked to them about their business, they have about 200 million in revenue, and they think they're going to make about 5% or $10 million
Yeah.
as EBITDA or pre-tax cash flow. And they were shocked when I pointed out to them that if they had half the revenue, $100 million of revenue, but the same percentage EBITDA, that would be a double the EBITDA, excuse
Mhm.
me, that would be a far better business.
Yeah.
So if they made 10 million on 100 instead of 10 million on 200, and they were shocked
Yeah.
because they spent all their lives trying to build the top line. So what we try to help them understand is you can do both.
Mhm.
You accomplish your mission, you fulfill your mission by having the fuel from the cash flow. And honestly, if we don't have that, we frequently fail in our mission.
Yeah. I love that. And I love the point you're making on the top line. That's the sexy number to talk about. Like, oh, we've got $100 million. Extreme example, $100 million that does 1% to the bottom line. Now that's a terrible efficiency, right? They're making $1 million versus a $3 million company that's putting 50% to the bottom line. They're making $1.5 million. Like the owner's coming out better from a profit perspective in that second example, even though they have a fraction, a tiny percent of the 3% of the revenue of the first company, but they know how to run a profitable business. And so now there might be, reasons that $100 million revenue company has a lot of value. We see this in we'll say the tech space a fair amount. They're losing money regularly. They might not have any money falling to the bottom line, and they have tremendous value. But yeah, I think I'd rather own the $3 million that's kicking off 50% profit.
Well,
So
there's that, and I think you're also pointing out that in the world that you and I live in today, there's a lot of slang among entrepreneurs about things like EBITDA multiple
mhm,
or revenue
yep,
multiple or the rule of 40 or whatever. And I would just say that in my experience and my career, that has not benefited entrepreneurs very
mm,
much. So entrepreneurs sometimes will talk, whether at the tennis club, the yacht club, wherever they hang out. Oh, she got 5.5 times EBITDA for her business, and she got 12 times. So, wow, she's so much smarter than her. And
yep,
actually, we would say that there's probably reasons that are located within the field or the industry that those multiples are different. But the thing I want to leave you with is that EBITDA multiple is a result. It's not an input.
yep,
So for all entrepreneurs listening, please erase the thought that EBITDA multiple drives your enterprise value, because it does not.
yep. That's great. And I think we also need to be aware too, I might be able to get a huge multiple if I offer some tremendous owner financing terms that uh, actually don't serve me very well. That actually put a lot of that equity at risk if the incoming buyer doesn't perform well. So I don't know. There's
The,
lots of different ways to look at that.
yeah, that, and I think that many entrepreneur owner managers also feel that their enterprise value can be constrained, and they are victims of what's going on in the market or in their industry at the moment.
Mm-hmm.
And actually, what we try to help them to see is that their enterprise value exit is the new investor's enterprise value
Mm-hmm.
entrance. So the biggest driver of enterprise value is what happens in the business over the next 3 to 5 years. What's your 3 to 5 year plan look
Yeah.
like? Is it filled with growth and profitability and adding great members of the team and
Yeah.
new parts of the market? Because if it is, wow, that's a really valuable
Yep.
business. And if it isn't, we better think about that.
Yeah, I love it. And there's so many reasons why that 3 to 5 year picture could look not as rosy if we have customer concentration or lots of different issues. So that's really interesting. And one thing I've also been thinking about in regards to enterprise value, and I'm going to give you some extreme examples here because I think it will help frame the discussion. On one end, if I use the E-Myth entrepreneur, or the E-Myth example of the entrepreneur, they like to bake, and so they open a bakery and they start to bake cakes and pies and these types of things, and they're sort of doing it all, right? They're the owner operator. And then on the other end, we've got, I'll use Hostess as an example. They're very corporate, right? There's zero customization. I get what I get from the convenience store and or the grocery store, and like that's the way it goes. And it's everything is sort of measured and managed, and the P&L really matters in that corporate example. So we've got these two ends, and I think when we think about enterprise value, I have to start bringing more corporate into the mix, right? I have to start building systems and processes and bring people in. And I can't have the value of the organization be dependent on me. Because if it's dependent on me, it's not very valuable. If I leave the situation, now the value goes down, right? And a buyer isn't very interested in that. What they want is to go, oh, great. We can take your systems and processes, we can plug them into what we're currently doing, we can create some efficiencies, and again, be able to generate more value and profit, in the years, beyond the acquisition. So, would you say that assessment is a fair assessment when we're looking at enterprise value and how to take it from the startup entrepreneur to really driving value?
So I would think that most entrepreneurs that you and I deal with earlier in their career arc made the decision, the ability to go from a rugged individual to a unique team.
Mm-hmm.
So let's just nominally say most entrepreneurs in the world never do that. That's why we have so many 1 or 2 man bands around. Okay, but the ones that you deal with and the one I deal with have made that decision, and they've successfully gone from rugged individualism to a unique team. And then your point is, okay, but what part of the corporate world do we need to bring in as we get larger, because we're stressing our systems, our people systems, our IT systems, our supply chain systems? And I agree with you, and I would ask this question. It's a little bit controversial for our clients,
Mm-hmm.
but if you think you might want to have a capital gain someday and you have a unique team, why wouldn't you tell your unique team right now that geez, I'm hoping to have a capital gain someday and I need your help. And you are all incredibly talented people who are having great positive input to this enterprise. And I don't know when I'm going to have the capital gain, but when I do, it seems fair only that I align some of your economics incentive to some of mine,
Yeah.
because I need your help and I want your contribution to increasing enterprise value. Do I know when this is going to happen sometime out in the future? No, I do not. Am I going to sell you stock in my business? No, I'm not. This is just a way to align some economic incentive. Now, that, Patrick, is a pretty controversial point of view, because, as you know, most owner managers would think, "Oh my goodness, I can't tell my management team, that I'm thinking about selling the business someday."
Yeah.
We actually argue the opposite, which is they are going to find out at the end of the day.
Yep.
So why wouldn't you tell them in advance and ask for their help?
Yep. And I'll say some of our most successful companies are doing exactly that. They brought their leadership team on
Great.
board, and they've got some structure like a equity appreciation rights, where it's like, hey, we're going to make
Right.
you some of these grants, and our goal is to get this valuation, because we're going to sell
Right.
this company at some point in time, and we're going to get there. And here's some of the like high level metrics we're going to use to get to that valuation. We're going to look at multiples and have some external firms give us an opinion on what our value is and whatnot. And so, and I've seen that be a very useful tool for the employees. They get excited about that opportunity to go, all right, hey, this is pretty neat. What other opportunities do you see to incentivize employees out there in the marketplace? Because there's, I think, a number of different ways to do it. And I think as the owner, they have a hard time figuring out what the right way is, right way. And
I think like a lot of our environment and the world we live in, things can get very complex very fast.
Mhm.
And there's actually plenty of financial engineers and trust and estate lawyers who can put as many bells and whistles on the things that you and I talk about. That we can put more bells and whistles we can even dream of.
Yeah.
I'm not doing that. I'm going back to very, very simple points of view, because many entrepreneur owner managers, if they wanted to have a partner, they would have already had one.
Yeah.
So they don't really want a partner. This isn't about having new shareholders or partnership. This is really about making compensation fair and equitable. Because if you're asking somebody to work harder and to help you on certain things, wouldn't you want to align their expectation? That's really what I'm talking about. I think also what many entrepreneur owner managers have this fear and oh my goodness, what are they going to think of me if they think I'm going to sell the business? Are they going to go somewhere else? They have a lot of old wives' tales,
Mm-hmm.
which like everyone knows that the CFO always gets fired. Not true. Everyone knows that strategic buyers always pay the most. Not true. But what may become evident to entrepreneurs is actually their management teams can get really positively activated on having a future career path that's actually more than the business that's just owned by that single entrepreneur. That maybe if there's a strategic investor here, or if there's a private equity firm who comes in and supports our growth plan with more juice, more capital,
Mm-hmm.
actually, there's more growth for me, the management. And maybe actually, if the owner eventually transitions out, maybe I could actually be the leader. So what I've seen over and over and over again is that kind of feeling on the part of the managers. It's very gratifying to the owner.
I love it. Yeah, no, that's fantastic, and I think there's lots of opportunities on how to put those things together, and it's interesting, just seeing. I've not yet seen the perfect solution, but I think giving people the opportunity to enjoy the upside of the business matters. We are getting into the busy season of tax planning. If your CPA hasn't called you yet to create a plan for 2024, it is soon going to be too late. We have 2 spots open for consulting clients that are wanting year-end tax planning. There isn't much time left for us to fully understand your situation and execute on your planning before year-end. If you want to be one of our clients that saves hundreds of thousands of dollars in income tax for 2024, go to vitalstrategies.com/client, and we'll be in touch to set up a time to talk soon. Again, there isn't much time left. We only have 2 spots left for 2024, so go to vitalstrategies.com/client and sign up for a call today so you can pay less tax, build more wealth, and live a great life. I want to also connect a few things that we've talked about. You discussed the rugged individualist, like transitioning to more of a corporate structure that's not dependent on them. And I think that all goes back to some of the mindset type things, because the reality is when we make these shifts in how we run our business, it's really hard. There needs to be an acknowledgement of that. When you start bringing people in, you're almost certainly going to do it incorrectly. There's going to be problems that you didn't have before, and the temptation is to just go back to, well, it was easy the old way. Let's just go back and do that. Where if I've got a mindset of, nope, I'm going to this place and I'm going to endure whatever comes my direction. We understand there's going to be bumps in the road, and we're going to work through those. I think that's a key piece of the growing of enterprise value. Like that has to be a part of the DNA of the owner operator. We're going to put up with all of the hassle that comes along with growing this and making this shift from me doing everything to putting the people in place to get it done.
So if I were going to point out the single most dramatic mindset shift I think we could take as entrepreneur owner managers together, it would be, if I go back 40 years in my career, mm-hmm. when I started in the M&A business, there was no private equity firm, yep. Not one. Soon, in the mid to late 80s, there came large ones like KKR and Forsman Little, who were doing multi-billion-dollar deals with public companies. Today, there are thousands of private equity firms in North America, and Preqin, who keeps the statistics on the business, says they've raised more than $1 trillion that they have yet to invest.
Wow.
So the mindset shift is that what used to be is that there was a terrible saying, but they called it the golden rule, and they twisted it to say, he who has the gold rules. I'm happy to say that is over. Mm-hmm. That today we live in a world of abundance of capital. No, actually, Patrick, we live in a world of superabundance of capital. And so actually what happens today is what the investors have, which is capital, is a commodity, and we can rent it at the same price from any one of those guys. What we have, what you have, is what's rare and valuable, which is a superior performing private business. And all the investors in the world, strategics and private equity, have discovered the private transaction market, and they're coming into it. So the mindset shift is really to understand, it's what I have that's rare and valuable. That's right. That's true. Yeah. And actually, you can go and interview the investors to see if they deserve the opportunity to be an investor in your business. That's the culture and the mindset shift we bring to this kind of business.
I love that. That's fantastic because you're right. Like the amount of dollars flowing through the economy right now is just incredible, and
Yeah,
just chasing opportunity. They're and back to the company I was talking about earlier. They've got three offers at $100 million valuation, and they're I don't think they're going to take it. I think their goal is to get to 200, but that's where some of their equity appreciation rights they've given the leadership team really sort of cash out. But they're entertaining the offers uh, just to see what kind of feedback they get on the business and the things they're doing well and not doing well. And so um, yeah, that's really
yeah.
interesting because we're seeing in that example like all of these dollars flowing around looking for a place to land, and this is a well-run company. They've got um, about 150 employees. They're growing 20% year over year. They figured out how to keep that going, which is pretty hard as your business grows. Continue that growth trend, and so yeah, that's you're absolutely right. And they're the like last one of their peer group that is at that size that hasn't taken on any private equity, and they kind of like it that way. They've got the secret, and they're continuing to grow, and the money keeps coming their way. So I appreciate that
So, so,
observation.
so, and look, I would urge anyone who's listening to us to lead and run their business as if they're going to own it
Mm-hmm.
forever, right? You make no decisions as if you're going to sell the business. All your decisions are made about the long-term best interest in the business, and that will help optimize enterprise value. But I will say that today, good companies, because of the environment we talked about, get approached every week.
Mm-hmm.
Some of them by private equity firms, some of them by business brokers who are fishing for listings, some of them by whoever. And sometimes people ask me, "Gee, I get approached all the time. Should I talk to them?" And I just wanted to talk about this for a second because you mentioned your friends who have had this offer. I think if an entrepreneur owner manager is can screen so they feel like they're talking to someone who's approached them who's a legitimate investor,
Mm-hmm.
that I sometimes urge them to say, yeah, why not take that meeting or take that phone call strictly for your own education? All you're doing is getting educated. So when that private equity firm says, oh, that's great, we'll come out and see you, send me 3 years of historical financials, and here's a non-disclosure agreement, you say, no, thank you. I'm not going to sign a non-disclosure agreement because there's nothing I'm going to tell you that's going to be confidential. This is all going to be about you telling me, why are you interested in my
Yeah.
industry? Why are you interested in my company?
Yeah.
What have you done other things like in this industry? And when you come out of that, you have a point of view. You might agree or disagree with it, but at least you'll have a new point of view of what some smart people think about your industry and your company, and maybe that's of use to you.
Yeah. Yeah. No, that's good. And I'm also I'm curious your perspective on company valuations. Like sometimes I think the owner has this expectation that it's worth X, and sometimes it's worth uh, X minus a number. Typically because I think there's so much blood, sweat, and tears brought into this thing, and they've had those conversations at the country club where they hear about the valuation of this thing or that thing, and they go, "Oh, that must be what my all cash offer is." Are you seeing people having realistic understanding of their values? Do they even understand? Do they know the value of their company when you first meet with them? Can you just walk us through where people's mindset are on valuations?
Yes. So let's start by just pointing out something that in the past 10
Mm-hmm.
years, there's been a lot of Silicon Valley startup to sell out, startup to sell out.
Mm-hmm.
And the way that worked was to start up, get as much growth as you possibly can, don't worry about
Yeah.
profitability, and do another financing at a higher value. And that's how you continue to get the value of the business. Okay, that is over.
Mm-hmm.
That was never a healthy point of view, but that's over. And our clients aren't in that anyway,
Yeah.
but I want to disabuse any of our listeners that that's what we're talking about. I think it is very unusual that our clients actually have thought very much about
Mm-hmm.
valuation. After all, they're entrepreneurs like you and me. They didn't actually start the business to sell it to make a lot of money. They actually were probably misfits in the industry, and they had a different way of doing things, and they realized I can deliver great value to my customer.
Mm-hmm.
And when it comes along and they say, oh, what's the next chapter for me? And if they meet one of our guys and they say, yeah, the business might be worth 85 or $100 million, most frequently those entrepreneurs are shocked. Really? I didn't think it could possibly be worth that much.
Yeah.
Sometimes they have a point of view, but more frequently than not, they're very surprised by what the value of the business is. And actually, even if they wanted to have a capital gain event in no closer than 3 to 5 years, there's some things they can be doing to kind of getting them and their team ready to think about how do you optimize enterprise value in a transaction going forward.
Yeah, I love it. Another thought I've had about enterprise value is I read a book recently by Nassim Taleb called Anti-Fragile, and
It's great. He's great, great
yeah,
thinker.
absolutely. And I don't love the term anti-fragile because it's not very descriptive, but I'm going to explain the concept for our listeners and sort of get your thoughts on how this ties to enterprise value. So on the one end of the spectrum, we have fragility, right? And if we think of it from a business perspective, we have very little cash flow, maybe really high debt. Any kind of turbulence that comes along could that company could be bankrupt in pretty short order. And then we move to resilience. Okay, a resilient company can handle the turbulence. Marketplace gets shaken up, and they go, but they don't break. They don't get any better, but they're just sort of survive. And so I think that's a great place to be. We should be constantly moving from looking at our business areas of fragility to resilience, and then I think the goal is to move from resilience to this like anti-fragile concept, or I don't want to know if I want to call it like mastery. I think of a master that's, when that turbulence comes, they get better, right? And I think about an organization that maybe has no debt, lots of liquidity, the marketplace falls apart, and they go, great. I can now go buy my competitors for pennies on the dollars. I can pick up assets for really cheap, and they're stronger because of that turbulence. And I see this fitting in really nicely with enterprise value, right? Like my enterprise value is much higher if I'm over here on this anti-fragile side of the equation versus the fragile side of the equation, because somebody can take me on, they can buy my business and go, great, we are positioned really well to not only grow, but because there's always these unknowns in the marketplace, I'll be able to get better because of our positioning. And so can you talk a little bit about like, is that mindset, am I tying those two things together okay between Taleb, anti-fragile, and growing enterprise value? I should be less fragile the more my enterprise value grows compared to my peers.
I think Taleb is a very, very gifted thinker, and I love Anti-Fragile. I love Black Swan. Love them all.
Mm-hmm.
Um, I think he uses the construct that if you have a wine glass in a shipment package and you drop it and the wine glass breaks, that's fragile.
Mm-hmm.
If you have a wine glass in a shipment package that has a lot of bubble wrap around it, you drop it, it doesn't break, that's resilient.
Yeah.
But then how can you get that wine glass to be anti-fragile? Actually, you can't.
Yeah.
That would involve you with dropping the box over and over, and it gets better and better. So there are some things I think that can become anti-fragile, and there's some things which don't have that characteristic.
Yep.
I think most enterprises do. Meaning, you used you were very insightful. You used a good story there, but saying like, if you have certain things that go on in your domain, in your industry, over a period of time, could it be that those shocks, which you experienced as like a bang, an ouch,
Mm-hmm.
actually helped you to become more and more strong, which puts you in an anti-fragile state? Honestly, Patrick, I think it's very challenging to do that as an entrepreneur, and most entrepreneurs who do well to go from fragile to resilient.
Yeah.
And I'm candidly, personally, I feel that way. Like, I hope we're resilient. I think we are.
Yeah.
Are we anti-fragile? I want to be anti-fragile, and we stick our nose there, and we take the risks as if we're anti-fragile.
Yeah.
But boy, that's a hard thing to achieve.
Yeah. Absolutely agree with that. It just, I think about it from aspiring to be that, if we
Yes,
can,
yes,
look at our organization and go, okay, in what arenas can we, let's fix all the fragile stuff first, because that's a big
yeah,
problem. And then once we sort of shore all those up, there's never going to be where we plug all the holes. Like it's just impossible.
yeah.
We could probably come up with some economic situation where it's just like, yeah, no, we're all out of business, and that's just the way it's going to be. But I think a little bit of, I think we're both maybe Ayn Rand fans, or at least,
Yes.
consumed some of the,
Yes, we
and
are.
then we sort of see the direction that we're going with government getting more and more involved. Like, hey, I'm from the government, I'm here to help. And it's like,
Yes.
we could probably come up with scenarios where, uh, a government failure, the dollar fails, economy shuts down in general. It's going to be, pretty challenging. But I think, in Atlas Shrugged, they're building the case for, here's how you become, anti-fragile. In those scenarios, you can still continue to thrive if you've created this tribe that can support one another. But not to get down.
Whether it's the characters in Ayn Rand's novels, or whether it's your clients or my
Mhm.
clients, I think they also do share one other characteristic. It's another Taleb book. It's called Skin in the
Mhm.
Game.
Yeah.
Whereas, when we are owners, we are principals in our businesses and we have skin in the game in those businesses. And that gives us some cognitive
Yeah.
biases that we can become aware of and try to make better decisions, but we've got them. And it's important to understand that when we're dealing with investors, they're not
Right.
principals, they're agents. It's not their money.
Mhm.
And they don't have those same cognitive biases. So I think for us as entrepreneur owner managers, one of the things we probably would be well to understand is that, are we dealing with somebody who's a principal with skin in the game?
Mhm.
Because if so, they may have opinions. And if you have skin in the game and you have an opinion, man, I want to hear your
Right.
opinion. But if you're someone who has no skin in the game and you have an opinion, it means nothing to me,
Right.
because there's plenty of opinions without a skin in the game. So I think that's another one of his theorems
Yeah.
that applies beautifully to entrepreneur owner managers.
Absolutely. And I think he also makes a great point on financial incentives. If I know your financial incentives, I probably know the direction your advice is going to go, right? Like if you're
Yes,
compensated by the, American Cancer Society, like your feedback is probably going to be favorable to what outcomes they're looking for. So
yes,
I think that's just something to keep in mind. That's awfully important. So
yes, yes. I mean, so show me incentives
mhm.
and I'll show you behavior,
Yeah.
right? Not completely,
Mhm.
not 100%, but it's certainly an influencer.
Yeah. I Fantastic. All right. Let's see. So I think it's important to understand um, like how your role works. Like I think our clients are probably listening to this going, man, I love the fact that I can sort of have Pete as a part of our team to help give us insight and guidance, if we're looking to sell at some point in the future. Can you talk a little bit about what those relationships look like? Because I just appreciate how relationship focused you are. You're adding value before you're asking anything from anybody, and they go, hey, I know who I'm going to call when the time is right for me to sell my business. It's going to be Pete, because he's helped us get to this point. So can you tell us a little bit about, you touched on this when we first started talking, but what a relationship looks like with Pete and Bigelow and the rest of the team there, and how that evolves over time as somebody thinks about growing their business and eventually maybe having a capital gain.
Yeah, so we have this crack team of people who are completely focused exclusively on entrepreneur owner managers and how to bring value to them. First, by building enterprise value,
Mm-hmm.
and then by capturing it in a capital gain. So to answer your question, I'll use a quick example. We have some friends and they're now clients in the Midwest who have a chemical formulation business. When we first met them, the value of the business was about 20 million. We know that because they had a valuation done. And when we looked at the business and met these two brothers, very, very charming guys and very interesting business, um, I mean, it didn't take a rocket scientist to realize that on the one hand, they were selling some of their formulations in 55 barrel drums to Ford Motor Company,
Mm-hmm.
and they were selling some of them in hypodermic needles to SpaceX. I'm not kidding.
Yeah.
That was true
Wow.
when I went through the manufacturing plant. And of course, you know the punchline here, which is when we asked about the gross margin on the 55-gallon drums is 15%, and the gross margin on the injections is 80%. It was pretty easy for us to be able to be wise guys from out of town and say, can we do more of this and less of this?
Yeah.
But we had a management team, these two brothers and their team, who were really vitally interested in building enterprise value
Mm-hmm.
for a capital gain someday. And at the time, they didn't know when it was. And so we began a process of investing in our own time to be able to work with them about, gee, should we consider doing a market study here?
Hmm.
Because if we did a market study, you're in these various domains, and maybe some of them you actually have a right to win, and maybe some of them you don't. And so we helped them to commission an expensive market study. It was a couple $100,000,
Hmm.
which then became a roadmap for them. And in the market study consultants were very funny. They said, when we asked you guys about your target markets, you told us 25 markets, but really in our analysis, you have six in which you have a right to win. So just throw out those other 19 markets and let's focus on this six. It's not going to be easy
Yep.
because you're going to have to fire some customers
Yep.
and you probably have to hire some talent from outside of your firm in the industry. And that roadmap went on for 3 or 4 or 5 years. And the ending of the story is about 4 years in, we were not done with helping to build the enterprise value of the business. But the brothers called and said, "Hey, enough. This is we've built the business as much as we can. There's some stuff we're up against. We're actually up against some of our relationship issues in our family.
Hmm.
Let's go to market
Yeah.
now." And so we did a transaction for just over $120 million, where we had about 10 or 12 offers from private equity firms, family offices, and strategics. The selling family chose a strategic investor from Germany, and they became the German company's North American outpost.
Yeah.
So what happened during that time was for the first 4 years and a half, let's call it, we worked with them and it's no charge to them. It's
Yeah.
priceless. And what we're doing is we're investing in our relationship and so are they.
Yeah.
And then when it comes time to pull the trigger, then we have a formal engagement letter, engagement agreement. And that takes about 6 months to go from going to market to closing a transaction. And that's really how it works. And look, along the way, it could be that we find out we don't get along, we don't share the same
Hmm.
values, and maybe they want to choose a different advisor or no advisor.
Yep.
Or along the way, we might feel the same way. But we really believe in a free relationship where each of us is contributing to the relationship, getting to know each other, and we find out very quickly, as you know,
Yeah.
is this these people one of us or aren't they?
I love it. I love it. So can I dig into that process just a little bit? Because one of the things that I think is out there, I just think of your breadth of network and relationships. Not every transaction's like not all buyers are. I think there's private buyers and sellers out there, right? And I think you guys do a great job of putting all of that together, which is nice just through your network. Can you talk a little bit about, you said I think they got 12 offers. Can you talk us through those offers and maybe uh, who those offers came from? And then I'm going to tie it back to this legacy. Like, how does this business continue beyond ourselves and sort of continue this thing we built? And how much of that factors into taking one of those offers?
So in our industry, the firms with which we compete all use a methodology which is exactly the same, which is tried and true, which is they write a book. They call it a prospectus or a sim or some other name,
Mm-hmm.
and they're writing a book which they then want to send out to as many investors as they possibly can. So an example would be they might write a book, they might send out 200 teaser letters with a non-compete agreement or a confidentiality non-disclosure agreement, and they then when those get signed, they send out books to how many ever people do it.
Mm-hmm.
About 20 years ago, Patrick, we concluded the right people were not reading the books. And the guys who make the decisions on the capital hadn't bothered to open the book.
Mm-hmm.
No
Yeah.
surprise. And so 20 years ago, we discarded that methodology and we used a technology enabled methodology. We used WebEx at the time. Now we've given in and we use Zoom like everybody else, where we actually have face-to-face meetings with all the investors, which comes after a series of outbound calls that we make to hundreds of investors in the world, trying to understand their acquisition criteria, their ability to finance, their desire to have these kind of management teams, et cetera.
Mm-hmm.
We get that down to a small number who pass our tests. We might send them a non-disclosure confidentiality agreement to a couple of dozen
Yep.
who pass our tests. And from there, we go on to a Zoom with them and we have a 90-minute or a 2-hour dialogue with the managing directors if it's a private equity firm, with the CEO, CFO, inside general counsel if it's a strategic investor, and we have a
Yeah.
dialogue. And in the dialogue might go something like this. They might ask, how does your client go to market? Do they use reps or do they use employee salespeople? And we say they go to market in their own geography using employee salespeople, and the other remote geographies they use reps.
Mm-hmm.
How do you go to market?
Yeah.
And so what happens is it begins to build this dialogue about where the fit
Yeah.
is. And when we get off that line, we don't know who the buyer is, but I guarantee you we know who the buyer's
Yep.
not.
Yep.
So we don't waste any time with those people. In fact, They don't even get the
Yep.
slides. We don't even send them the slides. All that information is totally confidential. And what we do then is find the ones that we like the best, and those are the ones who, put in those written offers. And they make this preliminary written, super detailed offer.
Yep.
It's non-binding, but it's super detailed, including like what are their sources of capital, what are their uses of capital, what is their plan for the management team, what is their desire for indemnity. A lot of complex topics we get into right away, so that when our clients look at those 12 preliminary offers, they really have a sense, oh, I see. We've created a market, and here's the range of value that's being offered. But here are also the really important qualitative, non-economic points that these people are making.
Yeah.
And from there, we then choose. We might choose one. We might choose a handful of those investors who we and our client want to meet the management team. And then we rehearse the management team very, very carefully, not to give them a script, but just to make sure they're ready for the questions that
Sure.
investors are going to ask.
Yeah.
Some of the time, actually, what happens, Patrick, is I was with a client recently who's got a business that we just closed a transaction, about a $600 million transaction, which for us is a large one. And they had 20 preliminary offers. And I said to the woman who's the CEO, it seems pretty clear to me that there's 20 and there's about 5 or 6 that are really at the top here of both economic and non-economic terms.
Mm-hmm.
And she looked at me, and she has a Boston accent. So she said, Peter, these 20 people all offered more than 500 million for our business, which we've been running for 35 years.
Mm-hmm.
I want to meet all of them because I want to see, what do they see about our industry and our business. I want to learn that
Mm-hmm.
because they all deserve a time. So actually what we did with her is we took her on the road
Wow.
to go visit all of them. And she wanted to see the culture where they lived and where they worked. And then we picked 3 or 4
Yeah.
to meet with her management team. So that's basically how it
Yeah,
works.
I love it. And I also need to acknowledge too, I love how you still get face to face, nose to nose with people. Even though technology has allowed us to shortcut a lot of that, you do a great job just getting out there and meeting people and building those relationships. That's a skill that's sort of lost now. We like to send text messages and emails, and after we met, you sent me a hard copy of your book. I'm like, I love this. So.
Well,
Thank you.
I would say to you that 85 or 90% of our business, and probably of
Mhm.
yours, can be done
Yep.
digitally. But it means that the other 15 or 10%, it's critical
Yep.
to be able to know when you and I need to be eye to eye, particularly with our entrepreneur owner managers. This is not just their business. This is part of their
Yep.
identity. This is part of their sense of meaning and purpose. So we called very quickly the idea to get in person with them. I was with someone in Chicago last week, and I said to her, I want to talk to you about this and this. And she said, you don't need to say anything. I said, what do you mean? She said, the fact that you're here speaks
Yeah.
volumes to me, that you took the time to come all the way out here and talk with me about this, my baby,
Yeah.
my business.
I love it. I love it. All right. So Pete, I'm curious, the best way to get in touch with you. I know people can go on Amazon and buy your book, Enterprise Value: How the Best Owner Managers Build Their Fortune, Capture Their Company's Gains, and Create Their Legacy. Great book. How else can people connect with you?
So, if you are an entrepreneur, owner, manager, here's a gift I'd like to give to your
Yeah.
listeners. So, if you're listening to Patrick Lonergan and Vital Wealth, if you are an entrepreneur, owner, manager, if you contact us, we will gladly send you a copy at no charge of our book, Enterprise Value, in an overnight mail to you. The reason I'm offering this is because we've had so much feedback
Mhm.
from entrepreneurs who were very isolated and very alone in this discussion, and who realized, oh, when I read this book, I realized other people had the same questions I had, and I didn't know that. So if there's listeners who'd like a copy of that, we'd be happy to send it to you. You can go on our website, bigelowllc.com. My cell phone number and my personal email is on the website, and I welcome all people who are entrepreneur owner managers.
Wonderful. Pete, thank you so much for all of your insight. And again, I'm going to repeat this. I run across a lot of people in our industry in lots of different avenues, from entrepreneurs to bankers and financiers, and just there's not many people that I say, hey, you're somebody that I aspire to, in regards to just how you conduct yourself and provide value out in the marketplace. And so I do appreciate that about you. I appreciate you joining us and sharing your wealth of knowledge with with me and the listeners. So thank you.
Thank you, Patrick. I'm thrilled to be here, and I appreciate you, friend.
All right. Very good. We'll talk to you soon, Pete. Thank you.
Talk to you soon.
Bye-bye. Thank you for listening to the Vital Strategies podcast. I hope you enjoyed this episode with Pete Worrell and gained some valuable insights into building enterprise value through strategy, culture, and mindset. We are getting into the busy season of tax planning. If your CPA hasn't called you yet to create a tax plan for 2024, it is soon going to be too late. We have 2 spots open for consulting clients that are wanting year-end tax planning. There isn't much time left for us to fully understand your situation and execute on your planning before year-end. If you want to be one of our clients that saves hundreds of thousands of dollars in income tax for 2024, go to vitalstrategies.com/client, and we'll be in touch to set up a time to talk. Again, there isn't much time left, and we only have 2 spots left for 2024. So go to vitalstrategies.com/client and sign up for a call today so you can pay less tax, build more wealth, and live a great life. Please rate and review the Vital Strategies podcast on your favorite platform. Your feedback helps us on our mission to save our clients and listeners over $1 billion in tax, putting that money back in your hands where it belongs. Those dollars are better used in your hands versus the government bureaucracy. Thank you for listening and for being a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities for your employees and driving growth. You're vital to your family, fostering abundance not only financially, but in all aspects of life that matter. Finally, you're vital to me because you strive to build wealth and make an impact through your business and live a great life.